Welcome to Turning Hard Times into Good Times. I am your host, Jay Taylor, and I'm speaking to you from New York City on this, the 30th day of January 2018. Before I talk more about today's show, I do want to remind you that I am the editor of Jay Taylor's Gold, Energy, and Tech Stocks, and you can subscribe to that letter by going to miningstocks.com, or you can call our office in New York City. Normal work hours in New York City, 718-457-1426, 718-457-1426. Would also like to encourage you to consider investing, or subscribing actually, and investing in Chen Lin's letter by going to chenpicks.com. Chen has done an exceptionally wonderful job actually for his investors, having turned a small investment of $5,400 into $2.5 million over 10 years. Chen's a good friend of mine. We continue to trade notes, and he's on this show from time to time as well. But consider going to chenpicks.com, learn more about Chen Lin's letter. I want to thank each of you for listening to the show, making it one of the more popular shows in the Voice America Business Channel. I also want to invite you to keep your questions, comments, criticisms, and praises coming along to questionsfortaylor@gmail.com. Also, want to thank our sponsors for making this show economically viable. Our sponsors for today's show: Bonterra Resources, Uranium Energy, Auryn Resources, Novo Resources, and Genesis Metals Corp. I've titled today's show, Is the Everything Bubble Reaching Its Expiration Date? Kevin Duffy, Nav Dhaliwal, and Michael Oliver return. As manager of the Baring Fund, Kevin has had a magnificent track record in protecting wealth from stock market crashes, with the current equity bull market among the longest on record, and with legendary hedge fund manager Ray Dalio just now, this past week, proclaiming the beginning of a bond bear market and predicting a stock market crash. We turn to Kevin for his thoughts about the direction of various markets in 2018 and to learn how the Barings Fund is positioning its investors. And Kevin will be with us during the second half of today's show. Last week, Nav Dhaliwal, the CEO of one of my favorite junior exploration companies, namely Bonterra Resources, was scheduled to be with me, but a pressing corporate issue occurred just as he was scheduled to come on the show. That kept him from joining me last week, but I'm happy to say that Nav will be with me right after their first commercial break today to update us on that company's Quebec gold deposit, the dimensions of which are growing very, very dramatically with this year's drill program. So you won't have to wait, however, right now for any commercial break to listen to Michael Oliver. Michael is with me. Thanks for joining me again, Michael.
Hi, Jay. Good to be back.
Always good to have you with me, and it's always important for me to tell my listeners it's olivermsa.com, olivermsa.com. Well, Michael, you headed up your weekly missive with something like the lids are coming off. Talk to us what you mean by that.
Well, I think the interest rate lids, bond prices down, interest rates up, is about to occur in a magnificently noisy way. And we've had a lot of bond declines, price declines, over the past 5-10 years, but they always stop, and then you go back up, and the rates go lower and so forth. And people are hypnotized by that and think it's just a process that goes forever. I don't. I think the major trend structures that could define a turn in rates to higher levels and higher levels yet again and again, in other words, change the major trend, are here. Right now, there's a day left in the month. T-bond futures are below the level they need to close the month out in order to avoid breaking massive annual momentum support structure. German bonds are below the level they need to be to save themselves. The only one of the three biggies that I'm watching is the JGBs, Japanese government bonds. Of course, they have futures contracts too. And they are marginally rat's hair above a level they need to close out the month to break. Now, they could close out next month below it and break it then. The number stays static all year. I think they're going to break. I think the JGBs will join in, and I think we're going to have a big bear market in bonds this year. Now, what does that mean? Well, I think on the other side of that, you're going to have a big bull market in commodities. I think the bull market's already begun. It's objectively measurable. We have gone up in the Bloomberg Commodity Index. You've gone up big time in copper. You've gone up big time in gold. You've gone up big time in oil. And I think the grains are on the cusp of blowing it out as well, and even cattle. So the food commodities are ready to join in this year, and I think they will. In fact, when I run my charts to my subscribers of annual momentum of corn and soybeans and wheat, you can basically take those charts and flip them upside down. It looks like the JGBs, the bonds, and the T-bonds upside down on their momentum charts. And I find that interest poetically justice there, that the incorrect definition of inflation is commodity price rise. We've had rampant inflation for all these last years, and it's gone into stocks. They don't call that inflation. It's only when food stuff goes up, then they say,
right.
That inflation. Well, you're about to get it. And the bond market's about to get it the other way. So I think the lids are coming off. And there's a lot of people that would debate me on that, and they do. And there's going to be a lot of chatter on both sides of that equation. And I really don't care. If you break the momentum structures, it's over, you're gone. And right now the bonds are doing it. The soybeans are doing it right now. Corn and wheat are very close. It's an interesting situation.
It really is an interesting situation. As I look at your T-bond charts and your weekly missive, it's very clear, where the structure is about to break down, and you're saying we are now below that level, I guess you're saying, right?
Yeah, we are below it, yes.
We're having an issue.
Having an issue there. Okay, now it's gone. Okay, I'm back.
Okay. All right, you're back.
Yeah.
All right. So equities, now you put out a missive just today, Michael, with the stock market having a second significant down day. What are you seeing for stocks? Are we nearing a breaking point here?
Shin bone connected to the thigh bone theory here. I think the real down in stocks is likely to commence in Q2, but the initial phase could occur this quarter. Specifically, February could start it, and we're already starting here in late January. I've got some numbers literally 0.5% below where the market is right now, that if you break them next month, which is, say, in 2 days or later, you're in some trouble, and you're likely to go down. But the down you'll see there probably won't be disastrous. It'll just be, several percentage points. You'll get a fist fight and up and down, and they're confusing, and people will debate it's a correction or whatever. The key is to get the S&P, which right now is just above 2,800, to an area around the high 2,700s as we open next quarter. Meaning, if you break the shin bone now and you start to wobble, and you're under pressure because you've done some technical damage, and you waste out the month of February and March, which is entirely likely if you do the breakage that I see, it doesn't mean you have to go down hard. All you have to do is go down a bit and then linger, because when you open next quarter, if you're anywhere between 2750 area and 2800 in that zone just below today's action, you're in big trouble. And so I see it as a two-part thing. In other words, let's go ahead and leverage the guy down, get him down into a position to where when he opens next quarter, it's untenable. At that point, you could get something more dramatic. So I see it as a two-part process. But you could be getting the initial phase of it right now. Don't get too excited, because I don't think it's going to be a crash here right now or anything of this sort. But I think it could be the kind of wobble that fools people, that some people will view it as a buying opportunity. Others might, if they're smart, will see it as, that's the beginning of the process, which is what we anticipate. But that entails a period of confusion at and below today's action over the next 8 weeks, let's say, where you get some down, but you don't collapse.
All right.
All you're doing is setting the stage so that when you open Q2, you're in real trouble.
All right, Michael, we're going to have to leave it go at that. But just one quick comment on gold. It's looking pretty positive, I suppose, right?
Oh,
you had a number we needed to close above this month.
Close 1350 or higher. Maybe we'll get it. Maybe we won't this month. Maybe it'll be next month. That's a price-based level. It's something that anybody with a price chart can see. We've been bullish since 1140, and we're an unbroken record. Nothing has changed that view. We think gold's going a lot higher. And it could be that we're in the biggest gold bull market ever, and we could be in the finality of a gold bull market, meaning we're headed for crisis situations in a lot of markets, and gold will express that. Yeah.
Well, unfortunately, we hope and pray that's not true, but it is what it is, and we need to be prepared for it, Michael, and I want to thank you very much for helping us be prepared.